Alright, in today's video we're breaking down a powerful statement from Dan Ives, who says where the trillions of dollars are going to in the market next, and even claims that Tesla could dominate up to 80% of its market. Dan Ives joined CNBC alongside 𝗗𝗟𝗏𝗧 to discuss whether investors still care about earnings, what this major credibility test means, and where the real opportunity is shifting in tech right now. I'm going to show you the clip first, then I'll break it all down and give you my full reaction, and after that we'll dive into 2 high-potential AI stocks to buy right now. Let's hear what Dan Ives had to say.
For more, let's bring in 𝗗𝗟𝗏𝗧's Dan Ives, along with CNBC contributor Requisite Capital's 𝗗𝗟𝗏𝗧 Dan, we'll start with you. You agree, investors, do they care about these numbers at all? Do they care about earnings, or is today more about energy storage or autonomous driving or AI chips or robotics?
Look, you care because ultimately you need to see stabilization of demand. I think they've seen that in spots. If you look China, Europe, I mean, that is important in terms of the core story. But the reality, going forward, this is an AI company. It's about autonomous. It's about robo-taxis. When you start to see the city ramp, talk about Houston, Dallas, when you see another 5 come on, ultimately, what does volume production look like when you talk about from a time perspective, cybercabs, Optimus? Look, to get the incremental $1 trillion evaluation, $1.5 trillion, it's going to be in AI. It's going to be really what I view. This is much more of an AI company, disruptive tech, than a car company.
Bryn, you say that the report today will be a credibility test for a company in transition, which speaks to those themes as well. What do you need to see in terms of checking the box for that credibility test?
I think when Phil and Dan obviously set it up, we want to hear about margins, first of all. Our margin's going to be sub 17, 18 is great, sub 17 probably gets a pinch. We want to hear about CapEx. Is CapEx for cars, or is CapEx, which we haven't talked about yet, for the Terafab facility, which is going to be very exciting. And so I think where this company is in transition is that it's clearly not just a car company. This is an AI company. This is a physical AI company with Optimus, with Cybercab. And I think that so many investors talk about the other OEMs getting the NVIDIA chips that can self-drive. The reality is that just gives them the software. Tesla has the millions and millions and billions of miles driven. So to me, we're looking for multiple things, but you want to have metrics of success. I think most people are going to focus on Optimus margins and robo-taxis from an earnings call perspective.
Dan, your $600 price target implies more than 50% upside for the stock. It's down 13% this year. What do you think really turns it around and gives it that bolster to get to that $600 price?
Yeah, look, for physical AI, the 2 best physical AI plays in the market today, it's NVIDIA and Tesla. But it's really, right now, it's the path to actually start to see the ramp into the second half of the year. This is a very important conference call from us to outline realistically. I mean, Phil always says, with a grain of salt, what it's going to look like in terms of production. What should we actually see in terms of cities on the road? That is extremely important. I mean, if you look, it's been slower than expected, but I think that's also been carefully, because the last thing they want to do is ultimately have some issue. So you're seeing city by city them ramping, and then it comes down to over the next year, you're owning this for the autonomous robotics piece, and they need to prove and show what the timeline is there, as well as the stabilization in demand that you're also starting to see in terms on delivery.
Is it cities on the road, or do you think it's more about the network? Is it one car in Houston, one car in Dallas, or do you need to see more of a broader rollout at this point in time?
You need to see a broader rollout, but cities are important because ultimately that is the start of what's going to be the network, where you're going to have 30, 40, 50 cities. In my opinion, they're going to own 80% of the autonomous market in the world. But as Bryn talked about, it does all start with rolling it out, showing the physical AI play. It's been underperformed this year, but I believe we sit here 3-6 months now, it's actually significantly outperformed.
And Bryn, you think the stock has a ceiling of about $450 per share. I believe you sold your calls at, what was it, $420 per share, which is a nice Elon Musk number. Over what time frame do you think that ceiling exists? And do you agree with Dan here that, in a month's time, we could start to see some real traction and what that would mean for the stock?
if we see real traction, the stock will be well above 420. I think it's going to take longer. Elon and his team do really hard things, right? And so that's where technically I'm very bullish on the stock long term, but just technically the stock is in a downtrend. And so I think, 400, by the way, is also resistance, but I sold my May, they'll expire, May 21st at 420. I don't think they get called away. I think it's going to be a few more quarters, but this company has so much call premium, so I'm more than happy just to be very patient, but sell calls on my positions that I own and collect really nice premium along the way.
Yeah, look, it's great thoughts there. I would also just say, when you think about SpaceX, coming in June in terms of the IPO, it's our view too, in the next year, Tesla eventually merges with SpaceX. And this is just an important dynamic as it plays out. I think that's sort of part of the golden goose for Musk as investors start to play this broader trend.
At the start, there's this question about whether investors even care about the usual things like earnings anymore, and Ives doesn't dismiss them completely. He makes it clear that demand still matters, especially in key regions like China and Europe. That's the foundation. If people stop buying the cars, the story falls apart. But he quickly pivots to what he believes is the real story, which is that Tesla is no longer just a car company, and this is the core thesis he keeps coming back to. In his view, Tesla is becoming an AI company, not just software AI but what he calls physical AI. That includes autonomous driving, robotaxis, and even humanoid robots like Optimus. The idea is that the future value of Tesla won't come from selling more vehicles in the traditional sense, but from building an entirely new ecosystem powered by AI. Now personally, I think this is where investors need to be a bit careful. Because while the vision is compelling, it's still largely based on what could happen, not what is happening at scale today. There's a difference between potential and execution, and the market has a history of pricing in potential way too early. But Ives is clearly betting that this transition is real. He talks about robotaxis rolling out city by city, mentioning places like Houston and Dallas as early examples. And in his mind, this is just the beginning of a much larger network that could eventually span dozens of cities globally. And that's a key point. It's not about having one or two autonomous cars on the road. It's about building a network effect. Once you have enough cities, enough vehicles, and enough data, that's when the model starts to scale and potentially dominate. He even goes as far as suggesting Tesla could own 80% of the autonomous market globally. That's a massive claim, and again, this is where I personally start to push back a bit, because competition in this space is not standing still. You have companies like NVIDIA providing the underlying technology for many automakers, and multiple players working on autonomy. Tesla has an advantage with its data, sure, but dominating 80% of a global market is an extremely aggressive assumption. Now, 𝗗𝗏 𝗚𝗏 adds another layer to this discussion, and I actually think her perspective grounds the conversation a bit more. She calls this a credibility test for Tesla. And that's important, because at this stage, it's not just about telling a great story, it's about proving it with numbers. She highlights margins as a key metric. If margins fall below a certain level, that's going to raise concerns. She also brings up capital expenditures, questioning whether Tesla is investing more into its core car business or into these newer AI-driven initiatives. And I like that she emphasizes the need for measurable success. It's one thing to talk about robotaxis and Optimus, but investors need concrete data points. How many vehicles are actually deployed? What does the revenue look like? How quickly is this scaling? She also makes a really strong point about data, which I think often gets overlooked. While other automakers can use chips from companies like NVIDIA to build self-driving systems, Tesla has something arguably more valuable, which is billions of miles of real-world driving data. That's a huge advantage when training AI models. But again, having data is one thing. Turning it into a safe, scalable, and regulatory-approved autonomous system is another challenge entirely. Then the conversation shifts to valuation, and this is where Ives doubles down on his bullish stance. He puts a $600 price target on Tesla, implying more than 50% upside. And the reasoning behind that is entirely tied to this physical AI narrative. He even goes as far as saying the two best physical AI plays in the market right now are Tesla and NVIDIA. That's a bold statement because it puts Tesla in the same category as one of the most dominant AI companies in the world. From my perspective, that comparison feels a bit premature. NVIDIA is already deeply embedded in the AI infrastructure layer. Tesla is still trying to prove its AI applications at scale. The upside could be there, but the execution risk is significantly higher. Ives also stresses that the upcoming periods will be critical. He wants to see a clear roadmap from Elon Musk on production timelines, city rollouts, and overall progress. And interestingly, he acknowledges that progress has been slower than expected but frames that as a cautious approach to avoid major issues. That's fair, because in something like autonomous driving, one major failure can set you back years. But at the same time, delays also test investor patience, especially when valuations are built on future expectations. Another important part of the discussion is the idea of a broader rollout versus isolated deployments. Ives argues that while you need a wider rollout eventually, starting city by city is how you build toward that larger network. It's a stepping stone approach. And that makes sense logically. You prove the model in controlled environments before scaling. But again, the timeline becomes everything. If this takes longer than expected, the market could start to reassess the premium it's giving Tesla. Bryn, on the other hand, takes a more cautious stance on the stock itself. She talks about technical resistance levels and suggests that meaningful upside might take a few more quarters to materialize. She's bullish long-term but not expecting an immediate breakout. I actually find that view more balanced. Because while the long-term story is exciting, the stock doesn't move on vision alone. It moves on progress, execution, and timing. She also mentions a strategy of selling call options to collect premium while waiting, which tells you a lot about her mindset. She's willing to hold the stock, but she's not expecting explosive upside in the near term. And toward the end, there's even a brief mention of SpaceX potentially going public in the future, which adds another layer of complexity. Because if that happens, it could shift investor attention and capital in interesting ways, especially given Elon Musk's involvement in both companies. So when you step back and look at the entire interview, what you're really seeing is a clash between vision and reality. On one side, you have this massive AI-driven future that could add trillions in value. On the other side, you have the current metrics, margins, demand, and execution that still need to hold up. And my takeaway is this. The bull case for Tesla has never been more ambitious, but it also requires a lot more to go right. If Tesla can actually deliver on autonomy, robotics, and AI at scale, the upside could be enormous. But if timelines slip or execution falls short, the stock could continue to face pressure in the near term. So this isn't just about whether Tesla sells more cars next quarter. It's about whether it can successfully transform into something much bigger. And right now, the market is still trying to figure out if that transformation is truly underway or still just a story being priced in. Now let's dive in and break down the two high-potential AI stocks you can buy right now that are quietly positioning themselves at the center of where the next trillions of dollars are going. One of them is powering the backbone of AI data movement at scale. The other is redefining how humans interact with machines through voice. Both are still early in their growth curve, and both could benefit massively as AI adoption accelerates across industries. The first company we need to talk about is Marvell Technology, ticker symbol MRVL. Before we even touch the numbers, you need to understand why this business actually matters, because if you miss this, you miss the entire investment thesis. Marvell is not the company you hear about in headlines every day. It is not flashy, it is not consumer-facing, but it sits in one of the most critical positions in the entire AI ecosystem, and that is data infrastructure. As AI models get larger and more complex, the amount of data being processed, moved, and stored is exploding, and this is where most investors make a mistake. They focus on the companies building the AI models, but they overlook the companies enabling those models to actually function at scale. Marvell specializes in high-performance semiconductors and data infrastructure solutions. In simple terms, it helps data move faster, more efficiently, and more reliably across massive networks. And in an AI-driven world, data movement is everything. Think about it like this. AI is only as powerful as the data it can process and the speed at which it can access that data. If you cannot move data efficiently between servers, chips, and cloud environments, your AI system becomes bottlenecked. Marvell is building the pipes that keep that entire system flowing. And what makes this even more compelling is that we are still in the early innings of AI infrastructure build-out. Data centers are being upgraded, cloud providers are scaling aggressively, AI workloads are increasing exponentially. All of that directly benefits Marvell. Now let's talk about what is actually driving their growth. One of the biggest catalysts for Marvell right now is its exposure to data center and AI-related demand. This segment has become the core engine of the business. As companies invest heavily in AI infrastructure, they need advanced networking and custom silicon solutions, which is exactly where Marvell thrives. In fact, a significant portion of Marvell's revenue is now tied to data center applications, and that percentage is growing. This shift is critical because it shows the company is aligning itself with one of the fastest growing segments in technology. And here is where it gets even more interesting. Marvell is not just selling off-the-shelf chips, it is deeply involved in custom silicon solutions for hyperscalers. These are tailored chips designed specifically for large-scale cloud and AI workloads. This creates a much stronger relationship with customers. Once you are embedded in a custom silicon design, you are not easily replaced. That creates a durable competitive advantage. Now, from a financial standpoint, the growth in AI-related demand is already starting to show up. Marvell has seen strong momentum in its data center segment, which has been one of the primary drivers of its revenue growth. This is not just theoretical, this is already happening, and as AI adoption continues to accelerate, that demand is expected to increase even further. But here is the part I think many investors are underestimating. This is not a one-year trend, this is a multi-year infrastructure cycle. We are talking about a global transformation in how computing is done. AI is not just another tech trend, it is a foundational shift similar to the internet or cloud computing. And when you have a company like Marvell positioned at the core of that shift, the long-term potential becomes very compelling. Now let's talk about margins and scalability. One of the advantages of Marvell's business model, especially with custom silicon, is that it can drive higher margins over time. As volumes increase and designs become more complex, the value of their solutions goes up, and because these solutions are deeply integrated into customer systems, switching costs are high. That means once a customer commits, they are likely to stay for the long term. This creates a powerful combination of growth and stickiness. But we also need to be realistic here. This is still a competitive space. Execution matters, product innovation matters, and timing matters. If Marvell fails to keep up with the pace of innovation or loses key design wins, that could impact its growth trajectory. But based on current trends, the company is clearly moving in the right direction. Another key factor to consider is how Marvell is positioning itself for the future of AI workloads. As AI models become more distributed, the need for efficient data movement between different parts of the network becomes even more critical. This is not just about processing power anymore, it is about connectivity and efficiency. And that plays directly into Marvell's strengths. So when you step back and look at the bigger picture, Marvell is not just benefiting from AI, it is enabling it. And that is a very important distinction, because enablers often have more durable growth than the companies at the top of the hype cycle. Now let's talk valuation for a second. Marvell is not the cheapest stock out there, and that is something you need to acknowledge. The market is already starting to recognize its role in the AI ecosystem. But at the same time, if the company continues to execute and capture a larger share of the AI infrastructure market, there is still room for long-term upside. This is not about short-term price movements. This is about positioning for a multi-year trend. And in my opinion, Marvell fits that narrative very well. What I personally like about this company is that it gives you exposure to AI without relying on a single application or use case. It benefits from the overall growth of AI infrastructure. Whether it is cloud computing, enterprise AI, or data center expansion, Marvell is part of that ecosystem. That diversification within AI is a strength, because it reduces the risk of being tied to one specific trend. Now, of course, no investment is without risk. You have to consider macro factors, competition, and execution. But if you are looking for a company that is deeply embedded in the AI supply chain with strong long-term tailwinds, Marvell is definitely one to watch. And this is exactly why it makes the list of high-potential AI stocks right now. Because it is not just riding the wave, it is helping build the wave. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now, the second company on this list takes a completely different angle on artificial intelligence, but it might be just as important when you think about how AI actually reaches people in the real world. We're talking about SoundHound AI, ticker symbol SOUN. If Marvell is focused on the infrastructure layer of AI, SoundHound is focused on the interface layer. This is where humans and machines actually interact. And in my opinion, this is one of the most underestimated areas in the entire AI space. Because at the end of the day, AI is only as useful as its ability to communicate with humans in a natural and intuitive way. And that is exactly what SoundHound is trying to solve. The company specializes in voice artificial intelligence, not just basic voice recognition, but full conversational AI that can understand, interpret, and respond to human speech in real time. Now, this might sound simple on the surface, but it is incredibly complex when you look under the hood. Most voice systems today still struggle with context, accents, background noise, and natural conversation flow. What SoundHound is building goes beyond simple commands. It is aiming to create a seamless, human-like interaction between people and machines, and this is where the long-term opportunity starts to open up. Think about how many industries could benefit from better voice AI. Restaurants, automotive, customer service, smart devices, healthcare, and more. Anywhere you have a human interacting with a system, voice can become the primary interface, and SoundHound is positioning itself right in the middle of that shift. One of the key advantages the company has is its proprietary technology stack. Unlike many competitors that rely on third-party solutions, SoundHound has built its own voice AI platform from the ground up. This gives them more control over performance, customization, and scalability. It also allows them to offer end-to-end solutions to their customers, which is a big deal, because companies do not just want a piece of the puzzle. They want a complete system that works seamlessly. Now let's talk about where this is actually being used. One of the biggest areas of growth for SoundHound is in the restaurant industry. The company is powering voice ordering systems that can handle customer interactions without human intervention. This is a huge deal when you think about labor shortages, efficiency, and cost reduction. Imagine a drive-through where orders are taken accurately and instantly by an AI system that never gets tired and never makes mistakes due to fatigue. That is not a future concept. That is already happening. And beyond restaurants, SoundHound is also making moves in the automotive space. Voice assistants in cars are becoming more advanced, and there is a growing demand for systems that can handle natural conversation rather than rigid commands. This creates another major growth avenue. Now, from a financial perspective, the company is still in its growth phase, which means you are going to see volatility. Revenue is growing, but profitability is not fully there yet. And that is something you need to understand if you are looking at this as an investment. This is not a mature, stable business like some of the larger tech companies. This is a company that is still building and expanding, but that also means the upside can be significant if execution is strong. One of the things that stands out is the company's growing backlog and pipeline of deals. This indicates that demand for its technology is increasing, even if that revenue has not fully been realized yet. And this is often what you want to see in an early-stage growth company: strong demand, expanding use cases, and increasing adoption. But here is where I want to add my personal take. Voice AI is one of those technologies that feels obvious in hindsight, but it has been much harder to execute than people expected. We have had voice assistants for years, but they have not fully replaced traditional interfaces. So the question becomes, is SoundHound actually solving the core limitations that have held voice AI back? If the answer is yes, then this could be a very powerful long-term opportunity. But if progress is slower than expected, or if competitors catch up quickly, that could limit the upside, and that is the risk you have to weigh. Another important factor is competition. While SoundHound has its own technology, it is still operating in a space where larger players have significant resources. That means differentiation and execution are absolutely critical. The company needs to prove that its solutions are not just good, but meaningfully better, because that is what drives adoption at scale. Now let's talk about why this company fits into the broader AI narrative. We are moving toward a world where AI is embedded in everyday life, not just in the background, but in how we interact with technology on a daily basis. Voice is one of the most natural forms of communication for humans, so if AI is going to become truly integrated into our lives, voice will likely play a major role, and SoundHound is building for that future. It is not just about replacing keyboards or touchscreens. It is about creating a more intuitive and efficient way for humans to interact with machines, and that is a very big opportunity. From an investment perspective, this is more of a high-risk, high-reward play compared to something like Marvel. Marvel is already generating significant revenue and is deeply embedded in the AI infrastructure. SoundHound is earlier in its journey, but that is also where you can potentially see outsized returns if the company executes well. So it really comes down to your risk tolerance and your investment strategy. Do you want a more established player benefiting from AI infrastructure, or are you willing to take on more risk for the potential of higher growth in a newer segment? Personally, I think there is room for both in a well-balanced portfolio, because they are targeting different layers of the AI ecosystem. One is enabling the system to function, the other is enabling humans to interact with it, and both are essential. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now, when you compare both of these companies, it really comes down to how you see the future of AI playing out. Is the biggest value going to come from the infrastructure that powers AI, or from the applications that bring AI closer to users? That is the question I want you to think about, because both of these companies are positioned in very different but equally important parts of the AI ecosystem. So here is the question for you. Which do you think has the stronger long-term advantage, the company building the infrastructure behind AI, or the one shaping how we interact with it every day? Let me know your thoughts in the comments. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.